Okay, hi everyone. This is going to be the first lecture for Chapter 16. We're dealing with corporate operations. So we talked about in the past two chapters, right, about starting an entity, how you want to be taxed. And then we said, hey, if you are a C Corp, that's how you're choosing to be taxed. What are the consequences of forming that corporation and then dissolving that corporation from a tax perspective, right? So we kind of looked at the client walks in the door. Hey, can you please tell me the entity to be taxed as? We know that's separate from our legal structure. And we said, okay, maybe you want to be a corporation. If you form a corporation, here's the consequences. And at the end of the road, if you were to end this corporation, here are the consequences. Now we're looking at kind of everything between the sandwich, right? We looked at like the top layer of bread and the bottom layer. Now we're looking at like the meat and cheese in between. What are the tax consequences of running a corporation? So corporations, as we've discussed, file the Form 1120. It's similar to the 1040 insofar that it follows the basic tax formula, right? You report your income minus your deductions, gives you your taxable income. You multiply that by a tax rate, which gives you a tax liability. You back out credits and prepayments, and then you'll either get a refund or you'll owe money, right? Now, this chart here is kind of showing the differences between them. One of the things with corporate tax returns that we'll learn about, most of the deductions there, almost all of them, are business deductions. And we know the standard for that is really an ordinary and necessary business expense. So maybe your corporation has employees or it pays rent, right? This is in distinction to the 1040 that kind of has more like human deductions to it, like personalized deductions. For example, right, like student loan interest, an above the line deduction. You don't really get that on a corporate return because that isn't an ordinary and necessary business expense. It would kind of be like if you just extrapolate the principles from the Schedule C and you graph that on to the 1120, just business expenses. There is no like flat standard amount deduction you get or anything like that. So in theory, it's a simpler return, but I can tell you from being in practice, corporate returns are actually a lot more work. Now, this is showing us the formula here for the 1120. It's basically your gross income minus your deductions, gives you your taxable income. You multiply that times your tax rate, which will give you a regular tax liability. Add any other taxes to it. So for example, maybe a corporate AMT tax, which will give you your total taxes, back out any credits or prepayments, and then you'll either have taxes due or you'll receive a refund. So whenever we are operating the corporation, right, one of the things we have to be aware here is that we have to know what are our accounting periods and our accounting methods we're using. So generally our first tax return that we file, our first 1120, is going to be the same as the financial accounting year. What does that mean, right? So maybe your financial accounting year end is 12/31, right? That would then be the year end, the tax year end for your corporation. So need to distinguish fiscal year end from tax year end. Two separate things there, but we often use the fiscal year end, our financial accounting year end, as our tax year end starting out. Now, the other thing to be aware of here is not all businesses start on January 1st, right? And conveniently it runs through 12/31. Maybe you start in the middle of the year or a third of the way through the year. So just be aware that a corporate tax year end could be different than 12/31, although a lot of the times it is due. Once we then select our tax year end, we have to say, okay, what is going to be our overall method, and as well as what are going to be our specific methods. So in other words, whenever we complete this tax return, what is the overall structure from an accounting perspective we're going to be applying here? Are we going to be using the accrual method, the cash method, or some hybrid in between the two of those. And then likewise, in specific situations, right, for example, inventory or depreciation, what type of accounting principles or methods are we going to apply in those situations? So, for example, maybe generally we're an accrual basis taxpayer, but when it comes to depreciation, we're going to apply the specific method of maybe taking 179 or bonus depreciation to depart from that overall method. Now, the idea here is that corporations are generally going to be using the accrual method, the very large corporations. So you can see here of gross receipts, the $26 million test over the last 3 years. So the book says this, right? And a lot of times they use these very large corporations like Apple or Amazon. Clearly they're going to have 26 million in sales. However, right, when you're in practice, especially if you're like a small or medium firm, many of your clients are not going to meet this standard. In other words, their gross receipts are going to be less than 26 million. That just means their sales, right? Their gross sales. If that's the case, then they can use the cash method as their overall method. So like cash in equals income, cash out equals expense. It's a facts and circumstances scenario there. But generally, right, when you're dealing with corporations, a lot of the standards you'll see is a 12/31 tax year end, and a lot of times they use the accrual method. That's a very common setup. So, okay, we said we formed the corporation, we're now running it, we established when our tax year end is, we said what methods we're going to use to apply to everything that happened over that, that period of time. Now we're saying we have to make the distinction here between book income and taxable income. It's kind of like FASB, Financial Accounting Standard Board, GAAP, versus the Internal Revenue Code. So the idea here is what your net income is on your books and records. You know, if you showed me your income statement, that is not always and probably will not be your taxable income. In other words, they make you have adjustments to arrive to your taxable income. So the idea is I have here, right, you start with your book income, you make adjustments. They're often called M1 adjustments because there's a little schedule on the 1120 called the M1. And then you arrive at your taxable income. Sometimes it's, you know, an M3 if you have a really large corporation, but we're just looking at it at a starting idea here, right? We have to be aware that our book income does not equal our tax income because we have two different standards of that we're applying. So when we make these adjustments, M1 adjustments or book to tax differences, they can either be favorable, that is to say they decrease our taxable income, or they could be unfavorable, that is to say they could increase our taxable income. So for example, if you have a book to tax difference that requires an add back to book income, so maybe you subtracted an item on your book income, you got a deduction for it, where the Internal Revenue Code says, hey, you don't get that deduction. When you add that back, it's going to increase your taxable income and therefore it will be unfavorable. In distinction, right, if we have a subtraction from book income, this is going to be favorable, right? You reported income on the books that you don't have to report on the tax return. So that's a good thing, right? It decreases our taxable income. So at a high level, we said book income does not equal tax income. We have to make adjustments to get there. And we said those adjustments, one way we could classify them is if they're favorable or unfavorable. Another way we can classify these adjustments would be whether they're permanent or temporary. Now, a permanent difference or permanent adjustment does not reverse over time, whereas a temporary difference does reverse over time. So let me talk about two different simple scenarios here. You have on your book income, right? Municipal bond interest income, $500. Just keep it simple, right? When you go to do your tax return, you would say, hey, muni bond income is not taxable. That's going to be a subtraction from book income. That's going to be favorable. Likewise, that's going to be a permanent difference because always and forever, right, muni bond income is not going to be taxable. It's permanently excluded. It's a full exclusion, right? Now, on the other hand, right, let's talk about a temporary difference. Maybe you have a machine on your books and records that you spent $1,000 on, and you're going to be depreciating it straight line over 10 years. So maybe $100 a year for 10 years, right? Well, on your books, you have a $100 depreciation expense. However, on your tax return, maybe you use bonus depreciation on this item and you fully depreciate it. So you get a much bigger $1,000 expense in year one instead of a $100 expense. That's great, right? That's going to also be favorable because you're reducing your taxable income. However, the difference between the first example and the second is that the depreciation catches up to you. In other words, it's going to reverse over time. So if you think about year two, right, you're still going to, on your books and records, take a $100 depreciation expense. However, on your tax return, you fully depreciated that item, so you don't get the depreciation expense. So in that case, it's going to slowly reverse over time, such that at the end of 10 years on both your books and your tax return, that item's fully depreciated. But the question is a timing difference, right? When do you get the deduction? Do you get it now or do you get it later? In this case, what we've talked about with depreciation, you get all of it now. That's a permanent, or that's not permanent, that's temporary. That's like a big now, right? And then every year for the next 9 years, you get the back end of it, right? You have more taxable income than you would on your tax return, or than on your books and records, because that deduction for depreciation, the $100, the $100, the $100 in years 2 through 10, that's going to be a deduction on books that you don't get on your tax return. So again, two ways to describe it: temporary versus permanent, that's one way; favorable versus unfavorable. Now, this right here is just showing you some of the differences. Let's look at example 16.1 and 16.2. So here's 16.1. Looks like we have book income of 100 and taxable income of 122. So we know right off the bat, right, book income does not equal taxable income. And what they've done here, right, is they've looked and they've made these adjustments right here in light of book to tax differences. So muni income, right, on our books, we included this income. We don't include it on our tax return. So it's going to be a subtraction from income. That's why it's going to be favorable, right? And this is going to be permanent. It's never going to reverse over time, right? So you can look at that there. Likewise, you can see the other two items here. We have life insurance premium for a key employee, and then meals and entertainment that are an expense that are taken. So as it says over here, for premiums for key life insurance policies, premiums paid to insure the lives of key company executives are not deductible for tax purposes. So in other words, on your books, you took a deduction for that, but on your tax return, you have to include it. So you have to like reverse that out. If you deducted it on your books, you have to add it back from your books to your tax return. Now, M&E here, just meals, it really should just be M. Temporarily, for the time being, like 2021, 2022, they're letting you take a full deduction for meals. It used to be and will be, moving forward, 50% deduction. So once upon a time, right, if you did a $100 deduction for meals on your books, you'd only get 50% of that on your tax return, $50. So they changed that with COVID in order to help stimulate businesses and give them more help with regard to deductions. So 16.2 here, this is just saying that, hey, on your tax return, you don't get a deduction for federal income tax expense. So on your books, you do. On your tax return, you don't. you can read through these, right? The main ones, like here's one, right? Fines, fees, and penalties. You may get it on book, but you don't get it for tax. Federal income tax, you get it on book, but you don't get it on tax. You can see unfavorable, right? It's like if you get a benefit on books and you don't get that benefit on your tax return, it's unfavorable. In distinction, right, interest income from muni bonds, this is favorable, right? It's on books, but it's excluded from taxable income. Depreciation expense, so this is like what I talked about with maybe bonus or 179, how you could have a bigger depreciation expense initially on your tax return, but it will reverse over time. And likewise, right, if you think about it, if you remember your tax adjusted basis, it's really just your cost minus your accumulated depreciation. If you have on your tax return, you fully depreciated this in year one, that's going to change your adjusted basis, right? It's now going to be $0. In distinction on your books, because maybe you've only depreciated it by $100, your basis on your books is going to be $900 using that previous example. Where I'm going with this is if you sell that asset, right, at any given point in time, maybe in year 3, right, because you have different bases, one for your book and one for your tax return, you're going to have a different gain or loss on the sale of that item. Other items here, right, bad debt expense. So the tax purposes, you have to use the direct write-off method. For books, you could use the allowance method, so have to make that adjustment, right? Unearned rent revenue. So for tax law, for example, when you receive rent in advance, that's taxable income. On your books, right, if you remember in 281, it's just like unearned income that you slowly reverse out over time. Some of the other ones here, you can look at them. I'm more concerned with the simple examples we use, just trying to paint you a high-level picture here of going from book to tax and the differences, whether they're favorable or unfavorable, whether they're temporary or permanent. And again, this is just showing you here, right, if you were to give some numbers to it, how it would be in this case, favorable if it has the brackets around it, or unfavorable if it doesn't have the brackets around it. It's basically, right, what we did on our books versus what we're doing on our tax return and showing that difference right there. The next item here are dividends, right? So basically when a corporation receives dividends from another corporation, there's different ways we have to account for this on the books and records versus the tax return. Let's start with the tax return. This is simple. If you receive a dividend, it's taxable when you receive it. That's the rule, right? It's part of your income then. If you, on your books, receive a dividend, you have to look at your ownership percentage of that corporation to determine how and whether you're going to include that income in your income. So if you own less than 20% of the corporation, then it's the same thing, all of its income, right? Simple enough. If you own between 20 and 50% of the other corporation, then you have to use the equity method, where it's basically looking at your pro rata share of income from it. That's going to result in a difference between book and tax. And then finally, if you own more than 50% of the corporation, for book purposes, you have to consolidate your books and records. So that's like advanced accounting, advanced financial, right? They look through that. Let's look at 16.3 here to give this a specific example with some numbers. Okay, here. So we have a corporation owns 30% of another corporation. We know for our books that's going to trigger the equity method, right? And then it looks like they received $40,000 in dividends during the year, and the corporation that they have ownership of reported $100,000 of income for the year. Let's look at what they do on the tax return, the green, and the books, the blue. So in our tax return, we say, hey, we have $40,000 of dividends we received. That's taxable now. On our books, we apply the equity method. We say, they had $100,000 of income. We own 30%. We're going to have $30,000 of income. Accordingly, to get to our taxable income from 30 up to 40, we have to have a $10,000 unfavorable adjustment, increase our income. Now, imagine the same scenario, except we only own 10% of that other corporation. In that case, there is going to be no book to tax difference. It's going to be the same amount of income on both the books and the tax return. So don't worry about consolidations for the exam, but I think a simple question like using the example above or below is fair game, right? I'm just showing you that, hey, dividends, you have to be aware there's a book to tax difference for them. Next, we have a couple more slides, then we'll stop there. So goodwill, accounting for goodwill can provide for a book to tax difference. So if we have a corporation acquiring the stock of another corporation, the tax basis of each asset of the target is going to remain unchanged. Likewise, self-created intangibles retain a zero or close to zero tax basis and are not written up to their fair market value as we do on the books. On books, as I have here, ASC 805 requires books to have identifiable assets reported at fair value, with any residual amount being categorized as goodwill. As I have here, the book goodwill does not have a tax basis. Thus, if we have a stock acquisition, Corporation 1 acquires the stock of Corporation 2, it's not goodwill is not going to be tax deductible nor amortizable. There's no tax basis on it. So just be aware, right? If we acquire the stock, there's going to be goodwill differences, how we do it on the books versus how we do it on the tax return. Likewise, if we acquire the assets of another corporation, for books and tax, we're going to have a difference. So for tax, acquired assets receive a tax basis equal to their fair market value. Any excess paid over the net fair market value or fair value is going to be allocated to goodwill, which is amortized over 15 years. So this type of goodwill, when we acquire the assets, is going to have both a tax and book basis. This is different if we acquire the stock, right? Now, basically, as I have here, as the corporation amortizes the goodwill, there's going to be a favorable book to tax difference because tax deduction, that's not on our books. So you can see that there in 16.4. So we're going to pause here for stock options. I'm going to do 3 lectures, maybe 15 slides each, to piece this out where you can look at the examples and take it issue by issue. So we'll stop there for this lecture.